Viewers from across the U.S., Korea, and around the world, we're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me today at the New York Stock Exchange for our market briefing and to weigh in on the top stories of the day is Tai Wong, independent proprietary trader. Tai, good morning to you.
Good morning, Remy.
Well, what a day it is today, and inflation figures, hurricane aftermath, a lot to get through.
Yeah, I know. It's a fall day out there. I think it was 44 degrees when I woke up, and it was actually a little bit chilly. And then, of course, today is October 10th, and I always like to get that before we get into the day's economics. And it's an auspicious day for, a lot of Chinese Americans, Double 10, which is the 113th anniversary of the founding of the Republic of China back in 1911. It was actually the day of the Wuchang uprising in Wuhan today, in the city of Wuhan, and that was the uprising that it basically overturned the Qing dynasty, ending 2,000 years of imperial rule. So it's the founding day of the Republic of China.
And it's hard to believe, but it is October 10th already, and as you mentioned, a lot to digest this morning.
Yes.
So here in the U.S., we were monitoring the track of Hurricane Milton overnight. It made landfall around 8:30 p.m. Yesterday in Florida on the Gulf Coast, and I'm sure we were keeping our eyes on some of the damage and the aftermath. So here we are on Thursday morning.
And I think they're still assessing all the damage that's been done. No real count on the number, on the number of casualties. There have been people killed, people have lost their lives, yes. But it appears from at least what we're seeing right now that the hit wasn't as bad as it was feared. Apparently some wind shear took a little force out of the hurricane, Cat 3 when it hit. It went through Florida, and our studio in Orlando is out of power today. So great job to the folks who really got us online. Maybe just a couple minutes late, but that's a really a great job. We're glad they're safe. We're just a little out of power there. But there are other things that. Certainly, we've seen the pictures of Tropicana Field where the Tampa Bay Rays played. The roof has essentially been peeled off, which is pretty substantial. There's a big crane that hit one of the Tampa Bay Times building. But on a sort of more pleasant note, there's a kind of a famous guy out there, and they call him Lieutenant Dan because he has, from Forrest Gump, the character that Gary Sinise played, and he has one leg, and he refused to evacuate. Yes. And someone went to check on him afterwards and said, "Are you there? Are you there?" And he poked his head up, says, "I'm here." And he goes, "The safest place to be in a flood is on a boat. Just look at Noah. As long as there's water, it doesn't get into a boat, you're fine. The best place is in a boat." And it was really just kind of an uplifting story to see, a character like that, sort of survive. And then something that sort of brought a little bit of a smile to my face, in the midst of little levity, in the midst of a lot of tragedy and a lot of damage, is I think a sheriff said, "Be careful of gators swimming around in the waters."
Yep.
And I don't want to mess around with any gators.
And for people who may not be as familiar, those creatures, so alligators, are quite big, aren't they?
They're big and they're fast, and I think apparently they can outrun you on land in 100 feet. So if you can beat them for about 100 feet or so, they're so big and heavy that they'll slow down, but in 100 feet they're tremendously strong. So I just have to make sure I'm not in front of the alligator. I think I'll stay away from that for a little bit. But another indication that the storm may not have been quite as bad as feared is there's a market for catastrophe bonds, and they're called cat bonds, and they're usually issued by insurers to help take off some of the risk from the places they've insured. And catastrophe bonds are very popular. It's probably a $50 billion market, so it's not a huge market, but there are people who are interested in it because they are uncorrelated to anything else. The weather does not correlate to any other, financial issues or any countries like that. So, and they tend to yield 150, 200 basis points higher than a lot of other things. They're 3 to 5 year bonds, and so they pay more in coupon, and they're not correlated. So people love that. But you'll get a year like last year where there were virtually no storms and people made like 20%. But this year you have 2 big storms, so it's probably going to hurt a little bit. But those folks are thinking that they were fearing a loss of principal. So basically how a catastrophe bond works is, you pay $100, it puts into a special account, and then you pick up these 6.5% coupons or whatever it might be, and then at the end of the year you get at the end of the 2 or 3 4 years you get your money back, unless there's a storm, in which case you could lose part or all of your principal. So it is, there is an element of risk there, which is why you get paid more. But nevertheless, they were fearing principal losses of as high as 15%, and now they're thinking maybe it's only half that. So if you're an intrepid investor and you're looking for extra yield, I bet the next issuance of catastrophe bonds are going to require a higher yield to clear. It might be an opportunity.
Well, as you mentioned, we'll keep our eyes on any storms that develop in the Atlantic or the Gulf Coast as we head into not just this month, but the next month as well, because hurricane season will continue throughout most of this quarter. But as we're talking about hurricanes, we saw some of that effect in terms of jobless claims last week. So this morning we got CPI, inflation figures, as well as jobless claims, and tomorrow we'll get those PPI figures. But let's talk about what we saw this morning in terms of data points and also those Fed minutes yesterday.
Right. So, I was watching the gold price as it ticks, because it just updates faster, and I see gold go boom, hits the floor. I'm like, oh, CPI must be a little high. And I take a look, and I'm like, oh, CPI is a tenth higher in both the the overall and the core. And then I see 258 in weekly claims, and I look at gold, and gold was roofing. It dropped from about, I guess, maybe $26.20 an ounce, down to $26.05, and then immediately gained back everything it lost and a little bit more. And gold, for now, is up for the day, looking to break a 6-day, sort of losing streak. So these claims numbers are, very, very high. The highest, I think, since August of last year. Now, immediately the thinking is Hurricane Helene probably has a lot to do with this in terms of, hitting all these states, tremendous flooding. A lot of people probably, certainly can't get to work, but maybe they were able to file electronically, or maybe not. But certainly I think that has an impact. And then next week I think we'll have another impact from Helene as more people get back online, and you'll see those numbers move around. And then you'll have Milton as well. So I think that number is going to be a little messy and a little jumpy for the next 3 or 4 weeks. But if you look at the immediate impact, interestingly, is that the jobless claims number, I think, had a bigger effect than actually CPI, in part because the Fed has made it pretty clear that right now they're worried more about employment than they are about inflation. This inflation number, I think, likely keeps them from cutting another 50, but they'll probably likely continue to cut 25. And what was interesting, as a matter of fact, was just before those figures came out, I looked at the CME futures, and there was a 0.3%, a tiny little sliver, said we're pricing in no cut, actually, even for November and December. That totally changed. So in the aftermath of the data, instead of 75-25, 75 for a 25 basis point in November and 25 for no move, it moved to sort of 87 and 13, so it kind of halved a little bit. I think the great majority still think it's going to be 25 basis points. I think that is certainly the base case, unless we see something, sort of really extraordinary. And now there's some people thinking 75 basis points by the end of December in total, rather than the 0.3% who thought that would be no cut. So this is sort of the market messing around, trying to, day trade. So I think dust will settle. I think we'll look at 25 basis points. But it was interesting that the weekly claims number was more important than CPI today. And then you mentioned the Fed minutes. I had a scan through the Fed minutes yesterday, and what struck me really was in terms of the view of the of the FOMC, was it was almost uniformly pretty dovish, in that they were concerned about the great, you hear words like great majority, many, we're concerned that we're going to get a sort of deeper losses in in employment, which they did not want. So the 50 basis points was supported by everybody, except interestingly, Governor Michelle Bowman, who seems to really stand alone in terms of her concern that they didn't need to move 50 at that time. But not much reaction out of the market after the minutes, because the minutes is from a few weeks ago, and we've had that monster sort of payrolls report since then. Now, Danielle DiMartino Booth was telling us how that was not as big and as strong as it seems at first glance, but the market's still not drilling into inventories and backlogs and hours worked. So the market's still thinking, okay, we're at 25, so they didn't react so much to the minutes because that looks like it's information that's a little bit dated.
Yeah, and as you mentioned, the September jobs report that we got last week, it already does seem like a lot of time has passed since we got that, but we got better than expected non-farm payrolls coming in above expectations, 250K for headline numbers, unemployment rate coming down, and this came on the heels of the September Fed Reserve rate decision where we got a 50 basis point cut. And as Tai, you mentioned, we do get the employment report for this month coming out on November 1st, and there are a lot of moving parts between now and then we will get the Fed rate announcement for November following that. So.
Right, and that employment report, the November 1st report, for October is going to be a mess because you have this week's jobless claims. Next week is the survey week, so that's the week that they use to calculate payroll. And next week you're still going to have impact from Helene. You're going to have your first look at Hurricane Milton's. So I think if the consensus, if sort of 80% of the people think the ban and non-farm payrolls is going to be like this, I think for consensus it's going to be much wider because you just don't know really what's going to happen in terms of that payrolls number, and you'll have to figure that the revisions the following month are still going to be messy. So having two storms like this, pretty big back to back, throws a wrench into those figures, and I think the Fed will probably like to say, listen, steady as she goes, 25 is probably safe, let's see how we do in December, maybe another 25 then. I think they're going to have to deal with the noise that you see, certainly in employment, national employment figures.
Yeah, and before we move away from inflation, just some points. Just looking through some of the data points in the CPI, so we saw moderation in housing prices, which is in terms of inflation, that was good news. But we've talked about eggs, whether we're talking about the port strikes or the cost of eggs in the store, and it does appear as though there was an uptick in terms of the price of eggs, and it seems to stem from some of the outbreaks in terms of bird flu that we've seen last month.
That, and then I think this storm Milton has done some damage to the citrus belt, and you're kind of around that sort of harvest kind of time. So I mean, I don't know, I never watched frozen concentrated orange juice futures, but as you said, inflation on food, which people feel and see, has ticked up. I noticed another one, airline fares sort of jumped. Not sure what was behind that. It was like a 3.2% jump or something like that. Sort of led the inflation figures, and maybe that doesn't last, but certainly, a tenth above consensus on both the core and the headline is enough to say 25 is safe. We're going to get 25, and we'll continue to watch the economy.
So we've highlighted the increases we saw in terms of monthly changes in September for the CPI figures, but it does look as though gas prices, fuel, oil fell. But given the move higher that we've seen in energy, do you think that'll affect next month?
So the link between crude prices and gasoline is kind of a volatile one. It depends a lot on how many stocks there are, how are enough refiners refining, or are they some refiners are offline because they need to do some sort of care and maintenance. The summer driving season has come to an end, so it may not immediately impact gasoline. Interestingly, as over the past couple of weeks, as crude prices have jumped, gasoline prices have stayed near recent lows, at least near where I get gas. So unless there's a big strike on Iran's oil facilities,
Yes.
and we're still waiting for that retaliation. Now there's talk about maybe they'll hit the Iranian Revolutionary Guard sites or something like that. The administration doesn't want a shock to the oil market,
Yeah.
4 weeks out of the election. So I think if you get a big shock, certainly crude prices go up and gasoline prices will probably follow relatively quickly. But right now it seems like those two are relatively split apart from each other rather. The other thing I would mention is there's a true-flation figure that many people have started to look at over the last couple of years, and which suggests that it's a more real-time look. And that true-flation figure was down at 1.5%. Maybe 3 weeks ago, and it's actually climbed back pretty steadily to 2%. So it kind of corroborates the story, as you mentioned, about food inflation is finally sort of coming back and hadn't been seen in a little while.
Yeah, so a lot to keep our eyes on as we head into the next couple of weeks. And as you mentioned, Tai, the countdown is on. Hard to believe, less than 4 weeks until the presidential election.
Yes.
So, given everything we've seen in the Middle East, there's a lot geopolitically as well as politically, and I'm sure we'll continue to bring any updates to our viewing audience. So why don't we take a look at markets this morning? In terms of the major equity averages, we saw the Dow and S&P 500 close at record highs in the previous session, but in today's session we are seeing red across the board for the major stock averages. The Dow, Nasdaq, and S&P 500 all lower by about 0.2%. So I do want to shift our focus on over to Asia. So we're counting down to Saturday when we get the finance ministry speaking again, but we do have another session to go before that event coming up on Saturday. So what are we seeing over in China and in Hong Kong?
So the China benchmark index, the CSI 300, was positive, but little change. It was positive on the day, but really little changed. And that that kind of technical candle that says that the market is really undecided. They're not sure. But a friend of mine, who's really kind of a China expert, sent me something, on X, forwarded me something on X, and I'll read what it says at the announcement about this Saturday morning press conference. And it says, the theme of the upcoming finance ministry presser is on intensifying counter-cyclical adjustment of fiscal policy.
Okay.
So I don't think the market really loved that, because they're saying, oh, the problem is cyclical, so we actually have to fix it. The problem, as I think anybody who looks at China knows, is really structural. But if you're in China and you're a finance ministry or whatever it is, what are you saying? And you're saying the problem is structural.
Yeah.
That means there's a problem with the structure, and there's as a practical matter, one guy who's running it. It's sort of like saying the kingdom's kind of rotten. So what does that say about the king? So whatever you're thinking, you can't really say that. But if you think it's counter-cyclical, and counter-cyclical means a little bit of a tweak. I think they need more than a little bit of a tweak. So if we get just a tweak, it's not going to be enough. I think it's going to disappoint the market. In the meantime, I think the Chinese financial markets were cheered by the fact that Guotai and Haitong, the two brokerages, are merging. And this is their grand plan to say, we only want 10 leading brokerages by, in a 2 or 3 years' time. The government's going to enforce these mergers. And now the combination of those two is now bigger than CITIC Securities, which had been the leader. And they're part of the sort of the master plan is in the 2030s, China wants 2 or 3 leading brokerages that are world players. Now, whether they get there or not, there's a lot of time and a lot of hurdles in between. But that's what they're looking to do. But the issue and the issue is really, it's really not. It's a structural problem. If you can call it cyclical, but if you want to deal with it in a structural way, that's pretty clever. But now the market is thinking consensus is around 2 or 3 trillion yuan in fiscal stimulus, with maybe half of that going to the local governments, which used to make a lot of money by selling land. Well, there's nobody buying land right now. Those developers are all curled up in a turtle, just trying to look and to survive. So, as a matter of fact, $2 trillion probably isn't enough. I mean, that is, divide by 7, that's 1.4, 1.5, trillion. Sorry, so a little problem with arithmetic here. We're only talking about maybe $500 billion or so, depending on where they are, right? 7 times 7, $500 billion or so U.S. It's really not enough to turn that really, really big ship around. Their problems go a lot deeper than that.
Yeah.
So 2 or 3 trillion, if we get that, I think we may get sort of a little more of a correction as we go on. But we'll wait for Saturday morning.
Well, we will keep an eye on what comes out on Saturday morning. That will obviously be Friday evening for us, but we will bring you any updates next week on Monday.
Absolutely.
And before we move away from the markets, I very quickly want to take a look at Tesla.
Yes.
So today's October 10th, and that means it is Robo-Taxi Day.
Yes.
And we will get an announcement 7 p.m. Pacific, 4 p.m. Eastern Time. So what do you expect to hear out of this?
So I'm planning to watch it, actually. He's going to show up. Elon has sort of bet Tesla's future on robo-taxis. The whole idea is, you have a robo-taxi, you own a robo-taxi, and you're not using it, you can actually just use that as a taxi service and sort of make almost passive income out of your car. That's actually the dream. It seems a little far-fetched to me, but over time, it's been hard to sell short Elon for any length of time, because the guy is a visionary. Like him or not, for whatever he stands for, he's a visionary that we don't have guys like him, and you want guys like him. And as a matter of fact, before the sort of political sensibilities and controversies, I remember Bill Gates once said that maybe the best thing I can do for the world is just give my entire fortune to Elon Musk and let him do stuff with it. Right? This is a man who's a visionary. So anyway, he's going to show the robo-taxi, and people mumble, oh, it's not going to be live on the street. It's going to be, I think, in one of the film studios. I wonder if it's Warner Brothers. It's this new car. It's supposed to have butterfly wings, and so you need to knock people's socks off a little bit.
Yeah.
And I think Tesla shareholders, or anti-Tesla shareholders, are a little nervous about it, because the price action in the Tesla stock hasn't been great. We've had a lot of slightly lower highs, haven't been able to break up higher. I think we break up higher than the recent highs. I can't remember if it's 260 or 270. It could run a little bit if shorts have to run and cover, right? But, shorts. There are a lot of shorts have been carried out trying to short Tesla for over quite a few years. So I think we'll watch that. And in some ways, you want that to be successful if you're the market, because that's just going to say, you know what, this is new, AI is working. That's going to give the market, which has been kind of moody. It's a little moody today. Maybe give them sort of a little boost.
Yeah.
So I think it'll be important to the mentality of the market, certainly for Tesla shareholders.
And as you mentioned, when we're talking about Elon Musk, we talk about him a lot on the show. We mentioned how he appeared last weekend at Trump's rally in Butler, Pennsylvania, and here we are talking about him ahead of this robo-taxi event. And of course, we've also mentioned him when it comes to internet access in hurricane-hit regions here in the U.S. and the Southeast. So there are a lot of moving parts when we were talking about someone such as Elon Musk.
I was just looking at an article yesterday, and I use an Android phone because I like the phone and it's fold. But if you have iOS 18, so if you have an iPhone 14 or more, if you download iOS 18, or is it 19? I'm not really an Apple guy, but you can now actually get access to a satellite, and I think a lot of those satellites are Elon satellites. So if you're jammed up and you point your there's an long article, point your phone to the sky, it'll pick up a satellite if nothing, other things aren't working, and you'll at least be able to text and tell your family that you're okay. So I mean, a visionary, the Starlink satellite, there are thousands of satellites up there. So I'm kind of rooting for him. I really hope he knocks our socks off.
Well, we'll be bringing our viewing audience the latest update after this evening's event. So, Tai, as always, thank you so much for joining me. I look forward to dissecting the PPI figures and what comes out of the robotaxi event with you tomorrow morning.
Oh, great to be here.
Thank you, Tai. And coming up next, I'll be joined by Larry Dyer, fixed income strategist. So don't go away, we'll be right back.
All right.
Welcome back to Global Money Talk live from the New York Stock Exchange. Federal Reserve officials were divided on how much to cut interest rates at their latest meeting in September. Most favored a larger half percentage point cut, and minutes from the meeting revealed that 11 of the 12 members supported the half point cut. Those in favor revealed it better aligned with inflation and labor market conditions. Some officials had argued for a smaller cut at the July meeting, but found recent data justify the larger reduction. Joining me here at the New York Stock Exchange today is Larry Dyer, a retired managing director with 40 years experience as a fixed income strategist at major Wall Street firms. He is focused on market behavior and economics and joins me to weigh in on the latest Fed minutes released from the Fed. So Larry, great to have you back. Thank you so much for joining me.
Well, thank you for having me.
Well, we got the release of the FOMC meeting minutes from the September meeting yesterday. So what was your take after the release of those minutes?
I think it kind of more confirms the idea that we're looking at the economic projections from the Fed, and it also highlights how much uncertainty there is in the economic outlook. And because there's uncertainty in the economic outlook, there's uncertainty in the Fed guidance on the rate outlook. I did an exercise a number of years ago. I took the different Fed data points and I plotted them to a Taylor rule. And so you get a high and a low Fed funds forecast. There's 100 basis point or more range today in the longer run Fed funds outlook, nearly 100 basis points for 2024. Oh my God, why is it so big? Do these guys get in a meeting and fight like mad because they think the other guy's really wrong? No, they have different forecasts. So if you quote Keynes, if the facts change, I'll change my view. So they agree on how to respond to growth and inflation for the most part. They disagree on what growth and inflation are going to be. And so I did a few slides to kind of highlight that point. It's kind of fun for us because you can come up and say, hey, everybody else is making a big deal. out of the little deal. Go spend more time with your family. Don't worry too much about this. Think about the bigger picture, I think, to come. And that's what I would look to do given the data that we had. There was a move in the market. So I was here a month ago. 10-year note yields are around 3.6%. I'm here today. They're close to 4.1. That's a 50 basis point move. Why did that happen? Well, the lowering of rates was because payrolls were lower than expected. The increase in rates was payrolls are higher than expected. But the question I'd ask is it unusual to have a 30 or 50 basis point move? And the answer I get is no.
Yeah.
So what happens next, I think, is the fun component, and we can talk about that.
Yeah, and Larry, for our viewers out there, I'm sure most are familiar with what's happened when it comes to the Federal Reserve and monetary policy here in the U.S. over the course of the last several years. So obviously, we had the pandemic in March of 2020, and here we are, October 2024, but heading into this year, there was a lot of anticipation that the Federal Reserve would be cutting rates sooner rather than later, but it took until the September meeting, so that was the first rate cut from the central bank. So can you walk us through where we stand in terms of the economic data that matters?
I think the big data is and remains really inflation. Okay. You have the employment situation and uncertainty with that. And you have, with inflation, the growth rate for the economy. There's a lot of uncertainty about what the long-term growth rate is in the economy. The Fed dot plot, or the Fed longer run projections imply 30, 40 basis points of uncertainty. Economic models might imply a 1% plus or minus move. Gee, that's the better part of a Fed tightening cycle, and it comes under the we don't really know. So I come back to the idea that the Fed will do the right thing over time, but it takes time to figure out what the right thing is because we have to see the data come in. I saw a number of people saying, oh, the Fed did 50 instead of 25. What's the implication of that? We could take a look at some of the dots and just kind of put this into perspective. I wasn't surprised by the minutes because they gave us a dot plot that said, we don't agree. Some people want maybe 1 or 2 cuts this year. Some people want 4 to 5. Okay. Well, that's going to be a big difference. You could look at the dots and say, maybe as many as 9 people would have said, let's do 25 basis points. They're not all voters. A little inside the Fed routine, Michelle Bowman said maybe 25 is a better idea. They go alphabetically. Anybody in the voting list after Michelle might have said, I agree with you on 25, but it looks bad if we have too many dissents. So only one person dissents. And I learned that from Larry Myers' book on his time at the Fed, talking about the politics of dissenting. So we could look at the dots and say maybe 7 people didn't want to do 25, but they're not going to argue because what if you do 25 more now, or you plan to do 25 basis points more in December? It's 3 months of 25 basis points. Let's talk about how much money that puts in your pocket if you're an investor. It's worth 6 cents on a 3-month bill. It's worth a couple of basis points on a 2-year note. It's worth less than a basis point on a 10-year note. So all of the market movements that we're seeing are really explained by economic fundamentals and the uncertainty about the future, much more than the Fed path if you take this kind of dollars in, dollars out approach. So I have always favored that for a funny reason. I like money. So if I take the numbers and I turn them into money, I can decide if I'm excited or not excited about the opportunities in the market.
And Larry, I know that you have prepared a few slides for us. So when it comes to the dot plot here, can you walk us through what you're paying attention to, what matters, and what you're seeing?
Okay. Well, we can pull the dot plot up, I guess, for the people. I guess I'll go through, like, just going to 2024 if we highlight it. I'd mentioned there's a lot of uncertainty in the Fed outlook. Okay. So we can see it up on the screen. Great. So 2 people wanted to have, basically, if we think of things, We started at about a 5.3% dot plot for today. For 2024 year end, we had numbers on the order of 4.8. Then we go down to 4.6, and then we get into the 4.4 lot category. So easily two people could have descended, possibly far more if you thought, let's do 25, let's do 50 later. So all that the minutes did was confirm this uncertainty on the economic outlook in the near term for me. The longer run dots we speak to, and there we see a cluster at 3.5, a cluster at 2.9, and a cluster at 2.5. So you could easily say, gee, there's 100 basis points of uncertainty on the longer run Fed funds rate. What does that translate to for long-term rates? About 100 basis points of uncertainty. That's a big number compared to history. I have it in the packet, we needn't go to it, but if you looked at 2019, you would have had maybe 50 basis points of uncertainty. And perhaps less than that at different points in time. So the longer run dots are the Fed historically signaling the market about what they mean. And those long run dots fell from 4.2% to 2.5% and are now trending up. And part of that is, I think, just due to the models the Fed uses more than the equilibrium rate in the US shifting a lot.
And of course, while we're looking at your slides right here, I do want to ask you about some of the uncertainty that you mentioned. Can you tell our viewing audience whether this uncertainty is normal?
It's a little bit more than normal. As I'd mentioned, if I looked to 2019, the Fed had projected basically an unchanged, very little change to the Fed funds rate through the whole forecast cycle, 3 or 4 years. Okay. Nothing happening, don't worry, everything's normal. And how much uncertainty was there in the long run dot plot? About 50 basis points. And that comes into uncertainty as to what long run GDP is going to be. Everybody on the Fed forecasts they're going to get the 2% inflation target, right? You don't forecast, my job is to get 2% inflation, and then forecast, I am going to fail at my job, right? You're going to forecast that you're going to be successful. So all of the noise in the Fed forecast tends to be, in the long run forecasts, tends to be in just what is the growth rate for the economy. The honest answer is we really can't be sure, and it does change over time. But we can look for relationships that give us I think, a better long-term view of what the market is going to focus on and what the equilibrium rate outlook should be. But even when you have equilibrium, one of my favorite charts historically is every month 10-year note yields tend to move 30 basis points for some reason or other. Every year they can move 100 basis points for some reason or other. If you look at the newspaper, they might say, look who has the best forecast in January. Look who has the worst. And in December, they flipped. Why did they flip? Forecasting is hard. And there's a lot of noise in the data that flips things about. There was an old interview question. If you get next year's newspaper, what do you look for? The great answer was not the stock that went up the most. It's look at the stock with the biggest difference between the high and the low, right? So you want to think about what range is potentially correct. And as has been said, markets can be irrational longer than you can be solvent. So you really have to look at the risk profile, in my view. When we last met, it felt like yields were pretty low. We had that 100 basis point rate move, and we've had a pretty good reversal. Maybe it gets to be more interesting. We know the Fed is cutting. We know they're looking to cut order of magnitude 100 basis points this year and 100 basis points next year, and that gets them pretty close to neutral. And so when is neutral fully priced in? You don't have much upside. When are you pricing in a less accommodative policy, maybe an uptick in growth? That's your opportunity to say yields seem to be too high. My favorite economist tends to be Robert Shiller. He came up with irrational exuberance and the housing crisis, and the most recent book I've seen is Markets Focused on themes, not facts.
Yes.
So I'll focus on themes and sort of broad-based data. I'm not smart enough to get every day correct.
Well, Larry, we've walked through the dot plots, and I do want to ask you about some of the terms that you mentioned when it comes to the economy. But before we do, I do want to ask you about what we're seeing in the 10-year yield, because since you last came on and now we're looking at levels above the 4%, can you walk us through what has happened and why we've been seeing this?
Sure. For people who don't memorize this, we can bring up a chart perhaps.
Okay.
All right. And if we have that up, I'll just talk assuming we've got it. If I look at the chart at the start or at the end of 2023, 10-year yields were 4.85%. And the market theme was higher for longer, right? There's a little bit of easing versus a 5.3% or so Fed funds rate built into the long-term inversion of the curve. Then we had some slowdown in the economic data, a little bit of a peak in what's happening, and wow, the market rallied over 100 basis points on the 10-year note yield. But I won't say that's as good as it gets. That's pretty darn good.
Yeah.
So you went from taking Fed policy away from day to day, what are they going to do, to where are we going to land? We were landing in inflation stays high forever and the Fed has to really lean on the brake for a prolonged period of time. We'll see that inflation can stay high for a period of time longer than people thought transient meant, but it doesn't stay high forever if the Fed wants to lower it. At the other end, we got that low drop in yields. Okay, that was pretty much as good as it gets for the positive story in my view. And then that reversed as, gee, that spat of economic data that implied the Fed should ease reversed. To me, this is that understand how markets and data behave. If you're pricing in everything good in the economy, or everything bad if you're a bond guy, has to get much worse for yields to fall.
Yeah.
When you price in, gee, the Fed is only going to ease 50 or 100 basis points before the carry on the 10-year note is meaningfully above the long-run earnings from holding cash, there's money to be put to work in the long end of the market. And we've had this second reversal going from, say, 4.7 to 3.7. That's another big move, and it seemed to be about as good as it gets to this model. Now, if the data showed the economy slowing, you could have seen yields drop from that 3.7% level. But how long does it take to be sure the economy is slowing? 3 to 6 months of data. And you can see that in the price action. So given the outlook today, we're kind of saying, okay, we're getting closer to fair value. We're looking at this kind of a choppy environment, and the outlook is different than it was in May, right? Remember, the Fed put in a lot more easing at the September meeting, so we probably shouldn't retreat to the yields that we saw in May. It'd be nice if we did. It's probably a good buying opportunity, but maybe we get some consolidation between here and say 4.2, 4.3% on the 10-year note. We'll see how that plays out over time, but that's the way I would think of it today. And we can see a difference in other markets and how they've behaved, which I think is kind of a fun story too.
Of course. So we do have a slide here for the S&P 500 as well. So let's take a look at that and tell us why you think it's important to compare this to what we've been seeing with bonds.
Sure. Well, the S&P 500 chart, if you remember, bonds had a big rally in early 2024 and then traded off. And what did stocks do? They went up happy as could be. Well, that's a pretty big divergence. So something was inconsistent between how the bond market was behaving and how equities were behaving. Now, you might say, because the Fed's going to ease, equities are going to be fine. But if we take a longer term perspective, equities had dropped a lot from their recent peak and then were rallying back up. So in 2023, equities were hitting sort of the lower end of a trend line and had room to move up. So that, I think, really that valuation story explains part of this move up. Remember, the previous high for the S&P was, you know, well above, like 20% or more above the start, you know, the lower levels in late 23.
And the chart that you're referencing right now is S&P 500 index that's dating back to 2015.
And I put it at 100 just to make it easier, because I can't do subtraction and division well in my head. But we can see that the recent drop, or that drop in early 2023, 24, was pretty significant. So in my mind, I'm drawing a line along here. Oh, that's not quite where I would put the line. I'd probably take it up a bit, but we'll leave that be. And just say, if we look at the lower end of the line, maybe it's at that trend. The 200 line that you see in 2022, 2023 should be going up 7% or more a year. So we should be thinking today at a number around 2020 is the lower end of that line, and the upper end of that line is meaningfully above it today. Now, if I look at the two peaks, well, the peaks are implying about a 7% trend return in equity prices too. So it becomes, it's really hard to bet against equities in the long run. Even if you make a mistake, you're going to earn 7% over the next decade.
And that's not a bad problem to have, is it?
Yeah, but it's an even better problem to say, if I buy the low, I can make 30% in the next year, or 20%. And that's the debate that professional investors are having, and professional traders. But always it's a case of, it's really hard to bet against U.S. equities because they've tended to do well. Maybe things will change. They've benefited from low taxes. They've benefited from an increasing share of profits as a percent of GDP. So if you say, gee, we're going to come in and change the tax code, I could say equities have a pretty potential correction to them. But you look at the politics in the U.S., and I don't see it changing within the horizon that investors are going to pay attention to.
And Larry, you do bring up an important point, because given all the volatility, or despite all the volatility that we have seen in 2024 when it comes to the S&P 500, the Dow Industrials, the NASDAQ Composite Index, even the Russell Index, we're seeing considerable year-to-date gains as we head into the final months of this year.
Yes, and you know, it's always hard to say, here's a point where the market is going to correct. Sometimes you can look and say, here are the storm clouds in the economy that we really should look about, right? Maybe there's a little bit of an AI bubble. I thought there was an internet bubble. I was told for a year, 2 years or more, I didn't know what I was talking about. Ultimately, a sock puppet was not a good investment. To go to, was it pets.com?
Yes. Yeah.
But, you know, do you really want to fight that trend? It's interesting to say, is it an AI bubble? There were several Nobel Prizes given for AI in science. But to an extent, I think that's, we've harnessed the computer power that can look at enormous amounts of things. But if you try talking to an AI chatbot, you're like, I really hate this company that has me talking to an AI chatbot, or at least I come to that conclusion. So we'll see how it all plays out. But for now, we're in a fairly benign economic environment. If we were talking in 2006 or so, when the Fed was finishing up a tightening cycle, I could say, gee, I'm worried about housing. All right? If we're talking at the end of the 2000 cycle, I could say, gee, I'm worried about the internet and equity bubbles. Turns out there were other things that kicked in, right? There was the accounting scandals, which I think was a big piece of the early 2000s component. When you came to housing, there was a lot of talk of it was the further you dropped, the higher you bounced. But when they tightened up home loans, a lot of my stuff is very micro, bottom up. When they took the FICA for a home loan from 620 to 720, They cut out 35% of the people who could buy a home in 2006. Oh, it's going to take a while for housing to recover. That was the lower for longer phase for the Fed. Right now, there's, in my own mind, a debate of how should I look at the market in the long term? Can I identify what would be a really attractive level for bond yields? Can I find a tool that gives me an insight? Because bond yields have been 20%, or bill yields. They've been 0% in the past 30 or so years. Can I find a model that gives me an idea of where are we today in that trade-off? The answer is in the long run it's hard, but I can make a guess at something and look at some relationships.
Sure.
And you know, a lot of the economic models are based on, gee, you got a PhD in econometrics. If somebody says history doesn't matter, econometrics uses history to produce the future forecasts. Nobody wants bad, back data to be bad. But maybe it is. We've gone through how many different Fed regimes? Lower for longer, average inflation targeting, inflation fighting. We'll do the right thing. Right, look at the noise today. The policy to me is we'll do the right thing as the data evolves. We don't really know what's going to happen. But don't worry, we'll do the right thing. Now, if I look at things from a bottom-up perspective, I can think about what investments can I make. I can buy bills, I can buy bonds, I can buy equities. If I think about what drives the economy, it's wages, consumption, investment returns. So, to my mind, if I think about this from a finance perspective, you can buy GDP, which is everything in the economy, or you can buy bonds, just as a thought experiment. Now, bonds are riskless. So if bonds give you the same return as everything in the economy, you probably ought to buy bonds. If bonds give you a low return relative to everything in the economy, the answer is it depends. So if we go to the chart that I made, I have sort of different periods, which is humbling.
Yeah, we'll bring up that chart right now.
Okay. So if we look, I've got two different colors in this chart and a lot of history. I'm going back to the 1940s, 1950s. And the reason is nothing that we hear seems to hold up to a 50 or 100-year history. Because things change. So you want to be aware that things change. But recently, since Volcker, the idea that I started with was if I can get a bond return comparable to nominal GDP and, big and, inflation is controlled, then bonds look pretty good. And when did we see bill yields, in this case, get up to nominal GDP? Well, the early 80s, 1990. Okay, we're close and zigzagging in the 2000s. Was GDP 6%, or I'm sorry, in the 90s, GDP in the 5 to 6% range. And then when we hit the housing crisis in 2009, 2010, part of that GDP spike that we might see above 5% was payback for the GDP trough. So we had a payback period, maybe I shouldn't be using 6%, maybe 5% was a pretty good guess for that period. Look at that long period of zero rates. And now what is the Fed forecasting? 2% growth, 2% inflation, plus or minus a little bit on the growth. We had very high inflation. So you might say, well, maybe we should be above that 4% trend line. Because good God, GDP is running 15. And nobody knows what it's going to be. It's like, to me, that it's impossible to call the top at that point in time. But you could, I think, call the equilibrium if the Fed's going to be successful. So I would love yields to go back to 5% given this modeling, because you'd be well above what people think trend GDP could be. And that says something's really expensive and bonds are cheap, most likely. So this is like the model. I used the early period just to say, what was different then? Well, one thing is, there wasn't a bond market. The Treasury controlled interest rates in the 50s till 1953. You had inflation hit close to 20%, and it came down without the Fed or the Treasury doing anything funny. So if I look at the history, peaks in GDP, peaks in inflation
Why
take
don't
a
we
while.
bring up the inflation chart for our viewing audience as Larry
Okay.
walks us through this?
Okay, perfect. Thank you for that. So when the Fed said inflation is transitory, what did you think transitory meant? I thought it meant 2 years, 3 years, because I looked at this chart and I said, okay, if I look in the 1940s and the 1950s, we had inflation spikes last at least a year or more. Okay, I lived through the 1980s with the inflation spikes lasting 2 to 3 years or more before they turned, not to say before you normalized. And even if we look at the late 80s or the late 2000s, we have the inflation spike occurring above the sort of like 3% level, above the 2.5% level respectively, and they took years to normalize. So what was different about this inflation spike? To my mind, nothing. So we should have expected, gee, inflation is spiking with COVID in 2020, 2021, 2022. Maybe it'll take a few years before it starts to turn down and is clearly going lower. That's where we are today. So the debate today is, what will the equilibrium be? Look at those longer run dots for the range, and that's giving us an idea that the equilibrium has a pretty wide range it could be going to. We don't know. But what we do know with this modeling is yields getting well above 4% in the long end of the market is probably not sustainable. Yields getting really, really low, it's hard to call the bottom.
Well,
That's
Larry,
always been the case.
Yeah, I think it was very helpful for us to take a look at these historical charts, because hindsight is 2020, and when we're only looking back a couple of years, say pre-pandemic, to see how far we have come in the decades past, we see how low inflation is now. So I think it's very helpful for the viewing audience to not only see the differences in terms of growth, inflation, but also different central bank regimes as well. So thank you so much for joining me, Larry, and for walking us through all of this
Thank
today.
you very much.
It's my
Pleasure to be
pleasure.
here.
Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll be back tomorrow morning. Have a great day.
Thank you. Well, hopefully that worked out.
Yep. Okay, that is the wrap. Thank you so much, Larry.
Thank you again.
Thank you. And we're able to pull up the chart.